The most painful truth in investing is simple. Most people are terrible at it. Not because they are unintelligent, not because they lack access to information. It's because they have a fatal attraction to buying at the exact wrong moment. They wait for the party to be in full swing before they decide to show up. They see everyone else having fun, they hear the music thumping, they smell the success in the air, so they finally build up the courage to walk in, and just as they do, the music stops, the lights come on, the party is over. This isn't just bad luck, it's a predictable pattern of human behavior, repeated decade after decade. Think about it this way. Imagine a store that sells everything you could ever want. One day the store announces a 50% off sale. Everything is half price. Logic says this is the best time to buy. You get more for your money. But in the stock market, the opposite happens. When stocks go on a 50% off sale, people don't rush in to buy. They run away in terror. Why do we do this? Why do we feel safest when risk is at its highest? The answer lies in our psychology. When markets are soaring, our brains get a powerful dose of dopamine. It's the same chemical that makes you feel good when you eat your favorite food or win a game. We see stories everywhere of people getting rich. Your neighbor just bought a new car with his stock market winnings. A headline screams about a new crypto millionaire. This isn't just financial news, it's a powerful social signal. It creates a feeling known as FOMO, the fear of missing out. It's a deep, primal anxiety that everyone else is getting ahead while you are being left behind. This fear is a powerful motivator. It overrides logic and reason. You stop thinking about a company's value or its long-term prospects. The only thing that matters is that the price is going up, and you want a piece of that action before it's too late. This is what psychologists call social proof. We assume that if a lot of other people are doing something, it must be the right thing to do. If everyone is buying a particular stock, we think they must know something we don't. We trust the wisdom of the crowd. But the crowd in a financial bubble isn't wise. It's a mob driven by greed and euphoria. Markets breathe. They inhale. They exhale. These are the cycles of booms and busts. Understanding this rhythm is key, but it's harder than it sounds because each part of the cycle plays a different psychological trick on us. The cycle often begins in pessimism after a crash. No one wants to invest. The news is terrible. The future looks bleak. This is the point of maximum financial opportunity, but it feels like the point of maximum risk. Only the bravest or perhaps the most foolish-seeming investors are buying when there's blood in the streets. Most people are too scared to even open their brokerage statements. Then slowly things get better. A period of skepticism begins. The market starts to creep up, but most people don't believe it. They call it a dead cat bounce. They call it a sucker's rally. They are still scarred from the last crash. They are waiting for the other shoe to drop. As the market continues to climb, skepticism turns into optimism. More people start to believe the recovery is real. History is filled with painful examples of this cycle in action. Let's go back to the late 1990s. The internet was new and exciting. It was going to change the world. And it did. But investor euphoria got way ahead of reality. Companies with .com in their name, many with no profits, no clear business plan, saw their stock prices soar to, honestly, just absurd levels. It felt like a new gold rush. People quit their jobs to become day traders. Stories of instant millionaires were everywhere. The Nasdaq index, which was full of these tech stocks, more than doubled in a year. The feeling was electric. It seemed like a new era where the old rules of valuation no longer mattered. In March of 2000, the party came to a screeching halt. The bubble burst. The Nasdaq index proceeded to fall by nearly 80% over the next 2 years. Companies that were once worth billions went bankrupt. The life savings of people who had piled in at the peak were wiped out. An investor who put $10,000 into a popular tech fund in early 2000 might have seen it shrink to just $2,000 by 2002. How can you avoid being the person who buys at the top? The first step is to learn to recognize the warning signs in your own thinking. It starts with a simple mirror test. Be honest with yourself. Why do you want to buy right now? Careful analysis of long-term value or pure emotion, gone up a lot recently, afraid of being left behind while friends get rich, reading headlines that promise easy money? If yes, a red flag should go up. Urgency is a clear sign of danger. Sound investing is almost always boring. It's long-term and patient. Euphoria creates urgency. Act now or you'll miss out. That's a sales tactic. In a bull market, the market becomes the salesperson. If you feel a frantic pull to buy, pause, step away from your computer, take a walk, give yourself a cooling off period, days or even a week. That urgency, often your brain's FOMO, not reason. Listen to the stories around you, everyone bragging about market gains. Be cautious. Financial news dominating parties. Be wary. This is social proof. Widespread chatter says investing is easy and risk-free. Your barber giving stock tips. Classic overheated market sign. So how do we translate this awareness into action? The most effective strategy is also the simplest. Automate your investing. This means setting up a system where a fixed amount of money is automatically invested at regular intervals, say, every month. This strategy is called dollar-cost averaging. When the market is high, your fixed amount buys fewer shares. When the market is low, that same amount buys more shares. This simple discipline forces you to do the opposite of what your emotions tell you. It makes you a buyer when assets are on sale, and a more cautious buyer when they are expensive. Another crucial step: have a plan before the euphoria starts. Create a simple investment policy for yourself. Decide on your target asset allocation, 60% stocks, 40% bonds. Write it down. Commit to rebalancing once a year. If stocks run up and become 70% of your portfolio, rebalancing means selling some of those stocks and buying more bonds. Back to the 60-40 target. It's a powerful, counterintuitive discipline. It forces you to sell what has done well, selling high, and buy what has lagged, buying low. One of the best ways to avoid buying the peak and selling the bottom: cover your short-term needs. Have an emergency fund in cash to cover 6 months of living expenses. That gives you the staying power to ride out downturns without being forced to sell. No one can perfectly time the market. No one. Not the experts on TV, not the brilliant hedge fund managers, and certainly not you or me. The goal is not to become a perfect timer. That's an impossible and expensive ambition. The goal is to become a wiser investor. A wiser investor understands that their own psychology is their biggest enemy. They know the urge to buy when everyone is euphoric and the urge to sell when everyone is panicking. They build systems and habits to protect themselves. Good investing is more about behavior than brains, except that you will miss some opportunities. You will never buy at the absolute bottom, and you will never sell at the absolute top. And that's okay. You just need a reasonable portion of long-term market growth. Most importantly, avoid buying at the peak and selling at the bottom. Success is not about brilliant moves. It's about consistently not making stupid ones. Survive the cycles so compounding can work for decades. Next time you feel that pull, that urgent desire to jump into a hot investment, remember history. Take a step back, take a deep breath, and stick to your plan. This is your most valuable financial skill.